VIP John AG here. China is about to do something to the silver market that will make the rare earth export ban look like a warm-up act. Right now, as I record this, the Shanghai Futures Exchange has already suspended evening trading sessions for silver contracts. Let me say that again. The second largest economy on the planet, the single biggest importer and processor of industrial silver, just shut down nighttime silver trading. And nobody on mainstream financial media is talking about what comes next. Silver is trading around $33.50 on the COMEX. Gold is hovering near $3,300 an ounce. But in Shanghai, silver is commanding a premium of roughly 8 to 12% over the Western spot price. That premium is not normal. That premium is a signal. And if you understand what China did with gallium, germanium, and rare earth elements over the past 2 years, you already know the playbook. They restrict, they accumulate, they weaponize. And silver, my friends, is next on that list. Do not buy a single ounce until you hear everything I am about to lay out, because timing and strategy are going to matter more in the next 90 days than they have in the last decade. Let me walk you through the data, because this channel runs on documented facts, not feelings. China accounts for roughly 15% of global silver mine production, but here is the number that matters far more. China processes and refines somewhere between 40 and 50% of the world's silver supply. That means even silver mined in Mexico, Peru, Australia, and Chile often flows through Chinese refineries before it reaches the global market. So when China makes a move on silver exports, they are not just restricting what they mine. They are potentially choking the entire global refined silver pipeline. Now let us look at what has already happened. The Shanghai Futures Exchange suspended evening trading on multiple metals contracts, including silver. The stated reason was market volatility, but the timing is extremely suspicious. This happened in the context of escalating trade tensions with the United States, tariff announcements of 145% on Chinese goods coming into America, and retaliatory tariffs from Beijing exceeding 125% on American goods. This is not a trade dispute anymore. This is an economic war. And in an economic war, you control your strategic resources. China learned this lesson a long time ago. Let me connect the dots here because CNBC and Bloomberg are not going to do it for you. In recent months, China imposed export restrictions on gallium, germanium, tungsten, and multiple rare earth elements. These are critical minerals used in semiconductors, defense systems, and advanced technology. The restrictions were framed as national security measures, but the strategic intent was crystal clear: control the supply, control the price, and gain geopolitical leverage. Silver fits this exact profile. Silver is not just a precious metal, it is the single most versatile industrial metal on the planet. Every solar panel requires approximately 20 grams of silver paste. Every electric vehicle uses roughly 25 to 50 grams of silver in its electrical system. Every fifth-generation wireless base station, every military guidance system, every satellite, every advanced semiconductor packaging process requires silver. There is no substitute at scale for most of these applications. And China knows this better than anyone because China dominates global solar panel manufacturing, producing over 80% of the world's photovoltaic cells. They need silver, and they are making sure they have it. Now look at the Shanghai premium. In a normal, healthy, free-flowing market, the price of silver in Shanghai and the price on the COMEX should be very close, maybe $1 or $2 apart based on shipping and insurance costs. But right now, the Shanghai premium on silver has been running between 8 and 12% above the COMEX price. At certain points this year, that premium has spiked even higher. This tells you one thing with absolute certainty. Physical silver demand inside China is outstripping supply. Chinese buyers, whether they are industrial consumers, government entities, or private accumulators, are willing to pay significantly more per ounce than the Western paper market says silver is worth. This is a divergence. And divergences like this do not last forever. Either the Western paper price comes up to match reality, or the physical supply flowing into China dries up completely because sellers will always chase the higher price. Both scenarios are bullish for silver holders, but the second scenario, the supply cutoff, is the one that could trigger a genuine crisis in Western markets. Let me give you the COMEX picture because it is equally alarming. COMEX registered silver inventory, the silver that is actually available for delivery against futures contracts, has been declining steadily. We are looking at registered inventories that have dropped significantly from their peaks. Total COMEX silver inventory sits around 280 million ounces, but the registered category, the metal actually tagged for delivery, is a fraction of that. Meanwhile, the number of paper ounces traded daily on the COMEX dwarfs the physical metal in the vaults by a ratio that, depending on how you measure it, ranges from 100 to 1 all the way up to 300 to 1 on volatile trading days. This is the paper versus physical disconnect that I have been documenting on this channel for years. And China's next move could be the catalyst that finally breaks it wide open. Looking at the numbers, about 75% of you watching right now are not subscribed. If this kind of unfiltered analysis is cutting through the noise and giving you clarity that you are not finding anywhere else, hit that subscribe button. That is how we grow a community built on truth and data, not hype and clickbait. Drop VIP John AG in the comments so I know Team VIP is in the building. If this is not for you, no hard feelings. I do not chase empty metrics. I do not sell signals. I do not sell mentorships. I do not sell courses. I just lay out the data and let you make your own decisions. But if you find value here, subscribing costs you nothing, and it helps this message reach more people who need to hear it. Now here is where it gets truly insane, and this is the part they really do not want you to see. China has been building a strategic silver stockpile, and they have been doing it quietly. The People's Bank of China has been transparent, relatively speaking, about its gold purchases. They have added hundreds of tons of gold to their official reserves over the past several years. Their disclosed gold holdings are now well over 2,300 tons. But silver is different. China does not publicly report a strategic silver reserve the way they report gold, and that silence is deafening. Because we can track the import data, China's silver imports have been surging. In some recent months, China imported record-breaking volumes of silver, pulling physical metal from the global market at a pace that is not consistent with normal industrial consumption patterns alone. They are stockpiling. The import data shows it. The Shanghai Premium confirms it. And the trading suspensions are the final tell. Here is the smoking gun. When China restricted rare earth exports, they did not announce it 6 months in advance. They did not hold a press conference. They implemented export licensing requirements almost overnight. One day, the rare earths were flowing freely. The next day, every shipment needed government approval, and approvals were slow, selective, and in many cases, simply denied. The price of rare earth elements outside of China skyrocketed. Western manufacturers who depended on Chinese rare earth supplies were caught completely off guard. Defense contractors scrambled. Tech companies panicked. And China gained enormous leverage at the negotiating table. Now ask yourself this question. If you were a Chinese strategic planner looking at the escalating trade war with America, looking at your dominance in silver refining, looking at the critical role silver plays in technologies that both nations consider essential for national security, would you not use the exact same playbook? Of course you would. And every single leading indicator suggests that is precisely what is happening. The evening trading suspension was not about volatility management. It was about controlling information flow and price discovery while strategic positioning is completed. As I said in a previous video, watch what they do, not what they say. And what China is doing right now with silver is screaming at a volume that should be impossible to ignore. Let me address the physical versus paper reality because this is where the rubber meets the road for everyone watching. On the COMEX, silver is trading around 33.50. You pull up your brokerage app, you see that number, and you think that is what silver is worth. But try to buy physical silver right now. Go to any major online dealer. Check the premiums on American Silver Eagles. You are paying anywhere from $5 to $10 over spot depending on the product and the dealer. That puts your actual acquisition cost for a single 1-ounce Silver Eagle somewhere around $38 to $43. On generic rounds and bars, premiums have come down somewhat from the extremes we saw in previous years, but you are still paying $2 to $4 over spot for basic 1-ounce rounds. 10-ounce bars carry premiums of $2 to $3 per ounce. 100-ounce bars and 1,000-ounce bars have tighter premiums, but good luck finding immediate delivery on size. Several major dealers are reporting extended shipping times on certain products. The United States Mint has continued to ration Silver Eagle production, unable or unwilling to meet demand at the retail level. Now contrast this with the paper market. On the COMEX, traders can sell millions of ounces of paper silver in seconds, crashing the spot price without a single physical ounce changing hands. This is documented. The CFTC's own data shows concentrated short positions held by a handful of large banks that dwarf anything seen in other commodity markets. The Bank for International Settlements data shows that the notional value of over-the-counter silver derivatives is enormous relative to the size of the actual physical market. This is not conspiracy theory. This is published data from the institutions themselves. The paper market is a price-setting mechanism that has been disconnected from physical reality for years. And China's potential export freeze could be the event that makes that disconnection impossible to maintain. Because when refined silver stops flowing out of China, the Western industrial consumers, the solar manufacturers, the electronics companies, the defense contractors, they will need to source physical metal. And they will not care what the COMEX paper price says. They will pay whatever the market demands to secure actual metal. That is when premiums explode. That is when the paper price either rockets higher to match reality, or the paper market loses all credibility as a pricing mechanism. Let me address the bearish case head-on, because balance matters, and I am not here to be a cheerleader. The bearish case is real, and it deserves respect. First, if the trade war escalates into a genuine global recession, industrial demand for silver could fall sharply. Silver is roughly 55% industrial by demand. A severe recession could cut into solar installations, electronics production, and automotive manufacturing. That would reduce physical offtake and could put downward pressure on prices. Second, the COMEX has a history of raising margin requirements during periods of rising silver prices. We saw it in 2011 when they hiked margins 5 times in 9 days and crashed silver from nearly $50 down to the low 30s. They can and will do it again if silver starts running too hard too fast. Leveraged long traders will get liquidated, and the price will drop. Third, the dollar could strengthen significantly during a flight to safety event, putting pressure on all dollar-denominated commodities, including silver. Fourth, China could use the threat of an export freeze as a negotiating tactic without ever actually implementing it, similar to how they have occasionally done with rare earths before actually pulling the trigger. The threat alone creates leverage. So the bearish scenario is a world where recession kills industrial demand, margin hikes crush leveraged longs, the dollar spikes, and China uses silver as a bargaining chip rather than a weapon. That is a possible outcome. I will not pretend it is not. But here is the bullish case, and I believe the weight of evidence supports this side far more heavily. The structural supply deficit in silver is not going away. For the past several years, the silver market has been in a physical deficit, meaning more silver is being consumed than is being mined and recycled. The Silver Institute has documented annual deficits exceeding 100 million ounces. Some independent analysts put the true deficit even higher when you account for unreported industrial consumption in China and India. Global silver mine production has been essentially flat to declining. Major silver-producing nations like Mexico and Peru are dealing with political instability, environmental regulations, and declining ore grades. There are very few major new silver mines in the development pipeline, and even those that exist will take years to reach production. Meanwhile, demand is accelerating on multiple fronts simultaneously. Solar photovoltaic installations continue to grow at double-digit rates globally. India alone imported over 10,000 tons of silver recently, driven by both industrial demand and investment demand. Central banks worldwide are diversifying away from dollar-denominated assets, and while most of the headlines focus on gold, silver benefits from the same underlying monetary shift. J.P. Morgan, love them or hate them, has accumulated one of the largest physical silver positions in history through their COMEX vault holdings. They did not accumulate hundreds of millions of ounces of physical silver because they think the price is going down. They accumulated it because they know exactly what is coming, When the largest bullion bank in the world is positioning long on physical silver while simultaneously managing the paper short side, that tells you everything you need to know about where they expect the price to go. And now add China potentially freezing silver exports to this equation. You have declining mine supply, surging industrial demand, investment demand growing in Asia, central bank accumulation, paper market manipulation reaching its limits, and the world's largest silver refiner potentially cutting off supply to the West. If you have been watching this channel, you already knew the fundamentals were explosive. China is just the match next to the fuse. 3 key takeaways, and we are out. 1. China has already suspended evening silver trading, is commanding an 8 to 12% premium over COMEX in Shanghai, and has a proven playbook of restricting strategic mineral exports with little or no warning. The rare earth precedent is not a theory. It is documented history, and every indicator suggests silver is next. 2. The disconnect between paper silver prices and physical silver reality has never been wider. COMEX registered inventories are declining, dealer premiums remain elevated, and the paper-to-physical ratio is absurd by any rational standard. A Chinese export freeze would stress-test this system in a way it has never been tested before, and there is a very real possibility it breaks. 3. Do not panic buy, but do have a strategy. If you are accumulating physical silver, understand that timing matters. If China announces export restrictions, premiums will spike overnight, just like they did with rare earths. Having a clear plan for what you want to buy, how much you want to allocate, and what price you are willing to pay is far more valuable than reacting emotionally after the headline drops. The title of this video says, "Do not buy until you see this." And what I mean by that is do not buy blindly. Buy with a plan, buy with data, and buy with your eyes wide open. The unresolved tension is this. We know China has the capability, the motive, and the precedent to freeze silver exports. We know the trade war is escalating with no signs of de-escalation. We know the physical market is tight and getting tighter. The question is not whether China will weaponize silver. The question is when and whether the Western financial system is prepared for it. Based on everything I have shown you, I do not believe it is. And that gap between preparedness and reality is where both the danger and the opportunity live. This is not financial advice. I am not a licensed financial advisor. I am an independent analyst sharing publicly available data and my own interpretation of it. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Protect your capital. Stay sharp. And I will see you in the next one. Invest with logic, not hype. VIP out.